Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Kevin Carter, founder of EMQQ Global, and we're talking about investing in emerging markets today, particularly China and India. And we know that Chinese tech stocks have been on a tear lately, particularly since DeepSeek unveiled its AI model. But that was after years of significant underperformance. Meanwhile, Indian stocks have plunged this year and they are on the brink of a bear market, and Indian stocks had done very well in the past. So when we spoke with Kevin last year, he called India the perfect emerging market. And to be fair, he also believed that China pessimism was overdone and he was recommending investing in China for the longer term. So I'm really interested in Kevin's thought now on investing in China and India right now. So welcome back, Kevin. Great to have you with us today.
Thanks so much. It's great to be back.
So what's behind the rally in Chinese tech stocks? Is it mainly DeepSeek's AI breakthrough, or that famous meeting President Xi had with top Chinese tech leaders, or was it attractive valuation or other reasons too?
Well, I think it was a combination of all of the above and maybe some other things. Certainly the DeepSeek, reveal to the world it was an important catalyst in this. But if we kind of rewind back, as you mentioned, the Chinese internet companies that we invest in, Alibaba, Tencent, et cetera, they've had a terrible run. They sort of peaked in early 2021, and then they basically had a crash. And most of the crash was in a 1 year or 18-month period. But the last 4 years collectively, it's just been a very down and out time for these Chinese internet companies. And now what caused that was, I think, first of all, you had a backdrop where interest rates had gone from, essentially nothing to 5%. And that obviously hurt the valuation of a lot of, so-called risk assets. But you also had these two ongoing, fears that kept showing up in the headlines. One fear was the delisting of Chinese stocks like Alibaba from U.S. exchanges. And the other fear was the China tech crackdown, or Jack Ma is missing narrative. And both of those two narratives I thought were both somewhat ridiculous. But it didn't matter what I thought or tried to show people. If it shows up in the paper, over and over and over again, and it's scary, and everyone starts to believe it, then, it doesn't matter if it's true or false. If everyone believes it, that it's going to be true with the stock market, and China became quote unquote uninvestable, and that was a soundbite from Jim Cramer and other people, but that became the state of China, and in terms of its stocks. And last summer and in the early fall, the way I would describe it is that China's stocks, the internet companies, were so far out of favor that if you think of a scale, and on one, the one direction is fear, the other direction is greed, or I'm going to lose all my money, or I'm going to get rich. That sentiment scheme, that scale, it had gone so negative that the arm flew off of the scale, and it wasn't even negative; it was quote unquote uninvestable. So you had maximum pessimism, and because of that, the stocks were very cheap. So as you said, I mean, the valuations for some of these Chinese internet companies was in the single digits, and they are very profitable. They were sitting on loads of cash. And so, what I would tell people is the Chinese internet stocks could double and they would still be cheap. and so that was kind of the status of the situation going into the fall. They announced some issues to address real estate, and that led to a spike in Chinese equities that was pretty significant, actually just as significant as the current one. And then things sort of drifted off until January when DeepSeek showed up. So and what DeepSeek did was basically shine a light back on the sector and how cheap they were and how out of favor they'd been, and that they really had a lot of their own AI that probably, if all of our AI had value, then theirs probably does as well. And so I think the market finally, reflected that. But either way, I think that China's become investable again, but I don't think it ever really was uninvestable. It was just a soundbite.
Right, that's what you said last time too. So let's talk a little bit more about DeepSeek and the AI race, because NVIDIA and all other AI beneficiaries here in the US, they had plunged when DeepSeek revealed its AI model, because that raised so many questions about these tens of billions of dollars which are being spent by US tech giants. There's still many questions about DeepSeek, and some experts believe probably the company is using a lot more NVIDIA chips than it has disclosed, maybe NVIDIA chips that are being shipped to Singapore or to Malaysia. And it is, in general, it is probably spending significantly more than it reported. And today, Alibaba stock was rising early in the morning when this e-commerce giant Alibaba, they revealed their new artificial intelligence model. And it seems that Alibaba is trying to surpass DeepSeek as the country's top AI developer. So I was interested in your thoughts on where China stands in the AI race.
Sure. No, this is a great question. And again, I think part of the reason that the Chinese stocks have done well recently is because they had been so, forgotten about, uninvestable, nobody cared. I think people lost sight of the fact that a lot of these companies have been investing significantly in AI for a long time. So, for example, Baidu has had AI investment for a long time, and it also has the largest autonomous vehicle fleet in the world. That has 2,000 fully self-driving taxis deployed out on the street, which is significantly larger than Google's Waymo business, for example. And the market cap of Baidu is about $30 billion, and that included the search engine business, by the way. And the value of Waymo is $45 billion. So you got a self-driving car fleet that's twice as big as Waymo's and the search engine, and for all less than just the self-driving part of Tesla or of Google. And by the way, the company also has half their market cap in cash. So again, the people looked, they saw the AI, they remembered or saw the AI that these companies had and responded. Now, right after DeepSeek announced their model, the next day, Alibaba had an announcement that their Qwen 2.5 AI was in fact superior to DeepSeek. And that might be true because just a couple of days after that, Apple announced that they were going to use Alibaba's AI on the Chinese iPhones that they were making. So again, it was just a validation of the fact that, if AI is valuable, as our markets have said, then China's AI must also have some value. And in the case of Alibaba, what's also, I think, important, and I'm no AI expert, but one of the things that I've gleaned is that, you need cloud services and AI. I mean, the AI runs, the cloud, and in the U.S. case, the companies that have the cloud don't necessarily have their own AI. But in the case of China, the cloud leader Alibaba also has AI, and Alibaba's market cap. This may have changed in the last week or so, but Alibaba's market cap was less than the market cap of OpenAI, right? And Alibaba's business is, generates over 10 billion in revenue. It's profitable, and so again, the recognition that these Chinese internet leaders have just as much AI, or at least a meaningful amount of AI opportunity, it just kept showing up in the paper over and over, in a week or a 2 week period. So I think it's, China has legit AI. Now, whether they can monetize it or the U.S. AI companies can monetize it, that remains one of the open questions.
Very interesting. So let's talk whether this rally can continue, because as you mentioned, in October last year, Chinese stocks had surged after policymakers they introduced sweeping stimulus measure. It was a stimulus bazooka, and at that time, David Tepper, billionaire investor, he told CNBC that he was very bullish on China and he had bought everything related to China. And after a short period, the rally lost steam. And then these stocks are surging again. But if we look at the risk factors, in addition to macroeconomic and geopolitical risk and President Trump's tariffs. So do you think the rally can continue given that the country's economy still remains weak and we are yet to see any sustained and effective stimulus measures from the authorities?
First, let me say the following. I'm a long-term Omaha-style investor, so I don't make stock market predictions. I don't, as my partner Bert Malky likes to say, I don't know anybody that can time the stock market, and I do not know anybody that knows anybody that can time the stock market. So now, having said that, I can tell you my speculation about where things might go in the near term. So the first and I think most important thing I'd say is, again, China's stocks were so far out of favor to the point where they wasn't even, people were bearish. It was quote unquote uninvestable, right? And the sentiment that the increased sentiment we've seen in the last 6 weeks, it's nothing that is not, covered up all of the damage that was done in sentiment. So it's not, I don't think that there's massive flows going into these companies necessarily right now, which is what you will start to see if sentiment continues to get better. And again, because the pendulum swung so far in one direction, it wouldn't surprise me if it goes back the other direction farther. So that would indicate that I think, yes, if that's true, then I think that maybe this is just getting started in a way. And I that's just a kind of a gut feeling. Now, the other thing that you mentioned to talk about is the new president and the Trump second term has obviously had a whole lot of action in the first couple months, and ultimately, I think that it's the relationship between Xi Jinping and Donald Trump, the United States-China relationship, that's really going to set sentiment up to continue positive or go negative. So here's what I think about this. Now, obviously, there was talk about huge tariffs on China during the election. There's all sorts of tariff activity going on, since the term started. A lot of that focused on, the Mexico and Canada, but China's, in the mix as well. I actually think that Donald Trump will maybe surprise people with how he approaches China. And because there really hasn't been a lot of talk. I mean, there's a 10% tariffs out there and so forth. But here's what what I think and the reasons I think this. In December, on the 16th of December, before Trump took office, he was talking to reporters, and at the end of whatever he was talking about, as he was leaving, someone shouted out a question about Xi Jinping, and Donald Trump answered it, and he said, Xi Jinping is a great man. We're friends. And then he said, if the United States and China could work together, we could solve all of the world's problems if you think about it, unquote. Now, I don't know if that's true, that they could solve all of the world's problems, but I have long thought that maybe a better strategy is to embrace China. That doesn't mean we can't have tariffs and other things, but rather than have the hostility and the confrontational tone of everything, maybe Donald Trump has a bigger plan. And that was the first time I picked up on this. There was another comment a couple of weeks later where Donald Trump said that he wanted to go to China in his first 100 days. And I think I think either Donald Trump will go to China or Xi Jinping will come to Florida or to Washington, D.C. And whatever happens in that meeting is going to determine, deep sea, all these other things may not matter that much compared to that actual meeting that will happen sometime soon. And other people have picked up on this. The Economist wrote a piece about, maybe Trump has a grand plan for China and the U.S. And there's also been some good coverage about the way Donald Trump talked about China when he was out of office with different of his previous administration and plans he had and things he had wished that they had achieved. So the Trump Xi Jinping wild card, it's just such a big thing, but we have to wait and see where it goes. Historically, if Xi Jinping meets with an American president and at the end of the meeting they smile and shake hands, that almost always leads to a nice bump in Chinese stocks. But I suspect if China is really going to be investable again, whatever comes out of that has to help in saying that it is. Now, the other factor in this that's, I think, definitely worth thinking about is Elon Musk is now, however or why ever it happened, Elon Musk is now one of the president's advisors, one of his top advisors. And so we have to think about, what does Elon Musk think about this? And when everyone else was selling their ADRs and saying China was uninvestable, Elon Musk was pouring billions of dollars into building Tesla manufacturing capacity in China, the only wholly owned foreign auto manufacturer. And he has praised the Chinese government and their efficiency. He's praised the talent of the engineers in China, and so I don't think it has anything to do with money with Musk, but I think he's going to say what he thinks, and I have a feeling what he will say will probably be a lot different than what someone like Peter Navarro would say. And one other little element in this that's at least worth noting is that Elon Musk's mother, May Musk, is quite famous in China, and that's a recent thing. She wrote a book about raising her children, and she has become a star and an idol for the women and mothers of China. So again, that's not necessarily something that'll be part of the trade negotiations, but it's worth noting that Elon Musk and his family are, somewhat embracing China. So we'll see what happens, but it's definitely going to be important.
Right. It's going to be very interesting. And I totally agree with you that it is impossible to time the market. And it's always better to look at the longer term trends and structural forces that drive the markets over the longer term and invest accordingly. Now, let's talk about Indian stocks. And in fact, as I mentioned earlier, they had done quite well. And last year, India had become the most expensive market in the world, according to some valuation metrics. And it seems that everything was going right for India. The economy was growing almost at 7%. Growth rate, and the country was emerging as a clear beneficiary of China's economic downturn, and many large companies, including Apple, the likes of Apple, they were exploring geopolitical tensions. But now lately, the economic growth is slowing down. So in the latest quarter, India's GDP grew by 5.4%, which was the weakest growth in last 7 quarters. And the government also lowered its economic growth projection for the current fiscal year to 6.4%. Very impressive, but still lowest in 4 years. And we have seen that Indian stocks, they have sold off this year, and foreign investors, they have been withdrawing money, and they are putting up portion of that money into Chinese equities, which we, as you mentioned, that they were much cheaper. So tell us what is going on with the Indian stock market now.
Okay, well, first, let me talk about the valuation question. You made a comment about India having the most expensive market based on some measures, and that was true on a PE multiple basis. The price to earnings multiple for the MSCI India was actually higher than the S&P 500s at one point last fall. So I think it was 25 or so, and maybe the S&P was 24. But it was in the it was the highest in the world. But the PE multiple doesn't really mean anything without dividing it by the growth rate, because you're buying the future, and whatever the slope of that earnings growth is, if it's a faster growing earnings, then the faster multiple is warranted. So the PEG ratio, the PE divided by the growth rate, was pretty reasonable. It was only about 1.4, which was, at least a full 1% or 1 point less than the S&P 500, which had a PEG ratio of 2.4 or thereabouts. And so I didn't think it looked that expensive. Having said that, there were all sorts of signs of exuberance in the Indian markets. You had, first of all, you have a stock market that in the last 10 years has added 150 million new investors. So, 10 years ago, there were 30 online, investors, and now there's 180 million. So you have a lot of people that are don't have a lot of experience. And in that, the last 9 years, the Nifty 50 has had nothing but positive years. I mean, there's been declines, during some of those years, including a big one when the COVID showed up. But for the most part, these investors that are all new have really only experienced an up market. And I think what that led to, as we discussed a little offline, you had this frenzy of options trading going on amongst Indian retail investors, to the point where the Indian options market became 80% of the entire world's options trading, at least in terms of number of trades, not notional value. And that's a pretty clear sign of speculation, because the options, you're mathematically almost guaranteed to lose, just as you are if you go sit at a casino for a few hours. So that was a big red flag. And the IPO markets have been on fire, and there's even been a lot of small and mid cap IPOs, some of which were recording gains of hundreds of % on their first day. So you had all these kind of telltale signs, and as I mentioned, I was in India during November, and I had more than one non-investment professional that told me their side job was, trading the shares market. And so that also, I thought was sort of a red flag. So I'm not surprised that the market had the correction it had, but the question is, well, what now? And, is because, look, the economy, it had accelerated up to 7% from 6.5%, and I know the most recent quarter was soft, but I don't think there's any reason to think the Indian growth story is anything but where it was, 3, 6, 9, 12 months ago. You've also had, which is favorable for INQQ, what we do, and the consumption story. You had a decent tax changes that put more money in the pocket of the middle class consumer in India. And the other thing to keep in mind is that Indian households have more money in gold and more money in real estate than they do in stocks. And gold prices have done really well in the last year. Real estate's done pretty good too, but gold in particular has done very, very well. So on balance, even if the Indian consumer has had some negative wealth effect in his equities or her equity portfolio, it's been more than offset by gains in the value of real estate and gold. So I don't think the India story is broken. But look, markets, it's not a straight line. Markets go down all the time. Sometimes they go down a lot. And I wouldn't be surprised if the Indian stocks go down more in the near term. Normally these types of things, there's some sort of volatility and capitulation type of day when the towel gets sort of thrown in and then you reset and advance further. But there was a big down day last week, but that doesn't mean there can't be more. So I don't know when the bottom is or will be, but I'm sure that the long-term investors in India that are buying today are going to do great, and long-term investors about India, on September, the highs, they're going to do great too if they have the right long-term perspective.
Excellent. I wanted to talk a little bit about the impact of AI on India's outsourcing industry too, because we are witnessing that artificial intelligence is disrupting businesses around the world, and India's outsourcing industry that employs close to 5.5 million people, and it contributes about 8% of the country's economy. So now there are concerns that IT could severely disrupt India's outsourcing industry, because you think about people at call centers and back office support or accounting, and at least some of those tasks, they are going to be automated. Maybe we will have AI agents in call centers. So what do you think about the impact of AI on India's outsourcing industry?
Well, that's another great question. So when AI first, AI has been around for a while, obviously, and people have been talking about it for a long time, but obviously it's really sort of shown up, finally in the real world in the last couple of years. And, again, I'm no AI expert, but from what I do know, it seemed to me that one sector that could likely have serious disruption would be, the Infosys and other similar companies in India. And it still seems to me that is an area that could really, benefit from AI, which might not be good for the employees, but might be good for shareholders. Now, having said that, I've listened to Nandan Nilekani talk about this, and he's a little bit more optimistic. And of course, he's one of the founders of Infosys, so I defer to whatever he thinks about how this AI can impact positively or negatively, the India Tech 1.0 companies like TCS and Infosys. So that's an open question. Having said that, one of the other things that I saw this week, which was, I saw it online. It was, I think I saw it on LinkedIn actually, but it was an interesting thing where whoever wrote it said, well, you have these giant companies now, these Fortune 500 companies, and they say, okay, we need to do AI. AI is important. We have no idea what AI is or how to do it, right? And so they go to the consulting firms. and they also don't maybe totally know what's going on. But the idea was the consulting firms are getting a lot of big contracts to figure out how these big companies should use AI, even though maybe no one's actually making money. That the point was the middlemen were going to make money in the near term, and perhaps that evolves as part of the existing India tech companies like Infosys. Maybe it's the implementation of these things that can be a extension of their businesses. But I don't know. I mean, again, as you opened and asked the question, it's exactly what my first thought was, that those were the kind of jobs that can get replaced very quickly by AI. But I'm not so sure that's the right read, even though it seems sensible.
Right. I think some of these traditional jobs are going to disappear, but AI may create many more job opportunities too. You never know. So sorry for putting you on the spot, but I have to ask you, if you could invest only in one country right now, India or China, which one would you choose?
Well, right now, for how long?
Say for the next 1 year or so.
Well, I don't, first of all, thankfully, I don't have to decide to do that. I will decide to try to answer your question, though. Look, China's got momentum, and momentum, I'm not a market timer, but there's a lot of data and other, proof that momentum tends to, and almost by definition, it tends to continue. And so I wouldn't be surprised to see the Chinese internet stocks in 1 year be higher than they are now. So that's what I think about the Chinese companies. And look, the India story is the best emerging market story on the planet today. And there's nothing else like it. You mentioned earlier that I called it the perfect emerging market, and it is. It's the biggest population ever, the youngest population, the fastest growing. It's the world's biggest democracy. It's got the world's best human capital, including 25 S&P 500 CEOs, and it's got the India stack, the digital public infrastructure, which is worth at least $1 trillion in my estimation, and is a complete game changer for the country. And most investors have no idea what that even is. So I don't think the global investors really appreciate how good India looks for the long term. The next year, I think it could, again, the stocks have been going down recently. That's usually when you want to buy them. It's hard for people to do, but it wouldn't surprise me if those declines stop and things go back, towards the highs from just 2 months ago. So I bet it'll be a close race between the two. How's that for my answer?
Fair enough. But for the longer term, India is still the perfect emerging market in your view. Excellent.
It's got everything. It's got everything you want.
Okay, very good. So let's talk a little bit about EMQQ and INQQ. Tell us why investors should focus on internet and e-commerce companies rather than investing in just plain vanilla market cap weighted Indian or Chinese indexes.
Absolutely. Well, look, I've devoted my life, the last 20 years of it, to emerging markets and trying to figure out the best way for people to invest in emerging markets. And it didn't take me long to conclude that, first of all, you can't buy the iShares or Vanguard, emerging market funds and think you're going to make any money. And the reason is the indexes, the companies in the indexes, they haven't grown their revenue in 10 years. They haven't grown their earnings. In fact, both their revenue and their earnings have declined. So, the reason companies have value, the reason groups of companies have value is because they make profits. And the only way to grow the value is to grow the profits. And the traditional indexes are full of these state-owned enterprises, which are conflicted and inefficient and oftentimes corrupt. And so that's the result is they haven't increased their earnings and the value and the prices haven't gone up. So a lot of people, look around and say, why is emerging markets doing so bad? Well, because they're not growing. They're fundamentals. And so the value isn't growing. And so what I realized is you had to get more targeted. Initially, what I told people to do was just buy the emerging market consumer stocks, because that's the story. You have 6.5 billion people. They're emerging and they want more food and better clothing, and they want to go to movies and get air conditioners and get on an airplane for the first time and have their kids go to Harvard. And that's the story. That's where the real growth is. And so, but for the first half of my emerging market life, I told people just buy the consumer stocks, but then the smartphone showed up and the best consumer stocks became technology stocks. And, we see this in our own life. The FANG stocks have taken over our lives and our stock market in the last 20 years, first on PCs, then on smartphones. And now that's reaching India. And so you've got, 1.5 billion people almost, and their incomes are going up and they want stuff. And they're getting their first computer basically today, and it's not a desktop. It's an Android-based smartphone that's getting better and cheaper every year. It's one of the things that makes India so interesting is that when China was at this phase of its growth, there was no such thing as a smartphone. And now you can get a brand new smartphone in India for $12. So the biggest difference, besides being democratic versus communist, is the fact that the advance of personal technology has been astronomical in the last 15 years. So it really is just an incredible opportunity for long-term investors, because it's so early. If you look at the opportunity that some of these companies have, like Zomato, for example. Zomato, which is the food delivery leader, the DoorDash of India. I call it that just to give people a quick idea of what it is. And they are the leader in food delivery, but because the whole, almost everything in India has got greenfields, opportunities. Yes, they're the dominant food delivery company. Their fastest growing business last year was, or the year before, was restaurant supplies, Hyperpure, right? So that entire business opportunity is there, like Cisco in the United States with the green trucks unloading tomato sauce in the morning. And now they've got this quick commerce business, which is absolutely exploding. So India is as good as you're going to get, and it's got all these extra parts to it that the global investor just doesn't really appreciate.
Excellent stuff. We'll leave it there. But thank you so much for the fascinating conversation. And also thank you for joining us today.
Thanks, Nina.
That was Kevin Carter of EMQQ Global. Now let's recap the ETF tickers. So we talked about the emerging markets internet ETF. The ticker symbol is EMQQ, and this invests in internet and e-commerce companies in emerging markets, including China and India. And its top holding is Alibaba currently. And the second holding is Tencent. And then you also see companies like Pinduoduo, Reliance Industries, Meituan, etc. And the ETF, which is focused on India, is INQQ. It is the India Internet ETF, and this focuses on internet and e-commerce companies in India. And if you look at the top holdings, Bajaj Finance, Reliance Industries, and Zomato are the top 3 holdings in the ETF. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.